Accounting is French, Spanish, the language of business, or German. What is accounting? All right, it's the language of business. I see we have people still coming in, so just so you know, in the future, we're going to start right at 8 o'clock, so you want to try to get here a few minutes early. What I normally recommend is get here a little early and just kind of review your notes from the previous class, because these questions will always come directly from what we talked about in the previous class. Your seating today is super important, so if you're coming in late, just hang out where you are for a sec. I got to get you in the right seats, and the reason is who you're sitting with today, these are your groups that you'll be doing the first group project with. So we wanted you to get together, actually meet, and we're going to start kind of practicing what you're going to be doing on the first group project. So if you're just coming in, you can still log in. I put the PIN number on the board. So if you're ever late, you'll always find the PIN number on the lower left-hand side of the board. You can still log in, and hopefully, if you didn't miss too much, you'll still make most of the credit for the quiz. All right, so question number 2. These are easy today, by the way. Hopefully you'll find them easy. Accounting 2101, that's this class, relates to, is it managerial accounting, financial accounting, tax, or home economics? What is this class about? All right, this class is financial accounting. Next semester you'll take 2102, which is managerial accounting. And home economics, I don't know if you'll ever take that, but if you stick around in accounting, eventually you'll take a tax class. Let me point out a couple of other things. I'm just trying to using this first real quiz to give you some pointers on how things are going to be run. Last semester we had a few students who, so when you come in, you're welcome to study your notes, right, from last time. But when we begin the quiz, you got to put those away. And the only devices that should be open should be whatever device you're using to answer the question. So sometimes there are a few people last time had their laptop open with their notes on it and they're going through their phone to get the answers. So this is an individual quiz. You should not be talking to one another, looking at your notes, looking at your neighbor's device. By the way, normally you're going to be sort of randomized and you're sitting next to some random person. I wouldn't want to look at someone else's device because they maybe didn't show up to the previous class, right? So if you look what they answered, you might choose the wrong one. So encourage you, be honest, and be prepared for the quizzes every single day. All right, question number 3. Which group makes up the rules for financial accounting in the United States? Is it the Financial Accounting Standards Board, the Securities and Exchange Commission, the International Accounting Standards Board, or the Public Accounting Oversight Board? Who makes up for rules in the U.S. that we have to follow in accounting? All right, in the U.S., it's the Financial Accounting Standards Board. The international version of that, these are the folks in London that make up rules for the rest of the world. The SEC doesn't make the rules, they enforce them, right? All right, question, Question 4, the balance sheet. The balance sheet. Does it track earnings for a period? Does it explain the change in cash during a period? Does it explain the change in retained earnings? Or does it give you a snapshot of the firm's financial position at a point in time? I refer to it as a selfie. So what is the balance sheet? All right, so the balance sheet gives us a snapshot of the firm at a particular point in time. Question 5, an asset is. What is an asset? So, is an asset an economic resource of the firm? Is it an obligation of the firm? Is it revenues minus expenses, or is it food? Guys, be careful on this one. What is an asset to a company? Okay, so an asset is an economic resource of the firm. Okay, so a couple of comments here. First of all, I started on time today on purpose because I knew there'd be a lot of people showing up late probably the first day, and I wanted to sort of give you an incentive in the future to be on time. If you just came in today, guys, it's really critical that you end up in the right group. So I have got a sheet down here if you want to come take a look at it. You have to be in the right group today because these are the groups, again, that you'll be working with on the first group project. So before we jump into the actual material we're going to be talking about today, I want to give you a heads up on a few things that are coming up. Guys, if you just came in, come on down. You can take a look at this sheet, okay? So if you're not in the right group you want to be, so come up and look at this sheet. This will show you where to sit. One other thing I'll point out to you. If you think you might have a tendency to be late, you might want to print off a copy of this sheet so that you'll have it in your backpack. So it's posted on my business course. All right, so guys, hang with me here. All right, so I'm going to the last slide first. I want to point out what's expected to be for next time. And I want to give you some expectations about the group project that's coming up. It's due a week from today. So first of all, hopefully all of you were able to do the RA quiz that was due for today. So anytime we have a new reading assignment, you'll read the pages that are assigned. Then you'll go on and just answer 5 simple questions about what was in the reading. Okay? So there's RA quiz number 2 is due next time. It's based on the second reading assignment. Then the homework number 1 is due. Now the homework is based on what you read last time, right? So the plan is we'll always read about it, do a reading assessment quiz, then we'll talk about it, then you'll go home and do a homework, right? So today we're going to talk about what you read the first day, and then you'll go home and practice that. So that's due next time. Group project, there's the first group project, there are 2 parts to it. So the people you're sitting with today, those are the people in your groups. So when we get to introduce ourselves here in a few minutes, you're going to want to, so on, I'll say two things. So on MBC, I've posted 2 versions of the sheet you picked up today. There's an alphabetical listing of groups. So if you look up your name and you're a K, find out what group you're in. Then there's another version of that same spreadsheet that I posted on MBC that's by group. So it has all the people in your group and their email addresses so you can contact one another. Hopefully we don't have a lot of people absent today. I do see a few empty seats. But so if someone's not here in your group, please email them and try to get in touch with them because you're going to have to work together on this. The group project, guys, I'm trying to force you to kind of get into this a little deeper. You can't just sort of wait until the exam to learn this material. So doing this group project, you're going to cooperate with one another, and you'll learn it a lot better by actually doing something. And I just want to point out that you're going to also evaluate one another at the end based on participation. So as long as everybody's participating, trying to do their part, then everybody should get full credit. But we've had a few free riders in the past who never show up to any of the group meetings, they never participate, they never contribute anything. And so essentially, if you're rated pretty low by your group members, you may get a 0 or only partial credit on the assignment. Okay, so again, it's important that you all participate. All right, so the first group project, we're going to let me open up MBC. Sorry, where's my mouse? There it is. Okay, on MBC, I haven't made it available yet, but I will do it right after class. When you go in, you'll find 4 files. The first one is a set of instructions that tell you exactly what's required of the assignment. Then you got the group assignment alphabetical, which you have in front of you right now in hard copy form. And then there's the other version that's by group, sorted by group. And then this spreadsheet, this is the actual assignment. In the spreadsheet is where you're going to actually do your work. So I just want to point out what those look like. So first of all, here's group assignment alphabetical, which is what you have in front of you right now. The other version, group assignment sorted by group, so you can find your group members. And then this is the instructions. So please read the instructions carefully. The assignment is due a week from today. We're going to give you till midnight. I think my TA put 11:55 p.m., just so there's no question about it. But it's due by the end of the day next Thursday. So read the instructions carefully. It explains, for example, you're only allowed to talk to members of your own group. You can go to the accounting lab and they can provide some assistance. They're not going to do the project for you, but if you're stuck on something, they can help you get your wheel spinning again and go forward. But the only people you're allowed to talk to are members of your own groups. And let's see. You can read the instructions, so I'll just leave that up to you. The other thing I wanted to point out is the group project itself. It's kind of funny. I opened it. Let's see what happened to it. There it is. Okay, so I'm just going to give you a quick preview. When you open the spreadsheet, there's a number of tabs. So if you look across if you're not familiar with Excel, you will become more familiar with it as you do this project. But across the bottom, each tab, so the first tab just gives you some instructions. This is where you're going to put the group members' names when you turn it in. So you'll turn in one version of the file per group. So you have to designate somebody in your group to turn it in. And you'll type the names of the group members so that we can easily give points to the right people. You'll find financial statements from last year. So this is the balance sheet from last year, the income statement from last year. This is the list of transactions. We're going to practice this a ton today. So you notice there are 20 transactions here. And then you're going to enter, so based on what's written here, you're going to do a transaction analysis in this little spreadsheet right here. We're going to practice this today in class. We'll practice again next Tuesday. So you'll be fully equipped and ready to do this by next Thursday. All right? And then at the end, once you've done your transaction analysis from this page, you're going to prepare the balance sheet and the income statement for this year, year one. Right? So the financial statements over here, these are last year's financial statements. You're going to record the transactions, and it will give you this year's financial statements. Okay, I'll give you one more hint. Last year's balance sheet, remember we took a snapshot, a selfie, at the end of last year? Well, the end of last year is the beginning of this year, right? So that's our beginning balances. We're going to have those beginning balances because our transactions will then update to our ending balances, snapshot, at the end of the year. And then, of course, these transactions are going to result in your income statement for the current year, right? So that's your first group project. You're sitting next to the people you're going to do it with. And so I'm hoping that you'll be able to take today really seriously as we practice this. The reason I'm having you sit together today is because some of you may want to get together and get a head start on this over the weekend so that you don't have to feel stressed about it next week. We are going to practice this a lot more next week. So on Tuesday, we're going to hit this really hard. The homework you're going to do for Tuesday is exactly preparing you to do this project. Okay, so if you can't do it this weekend, if you don't feel like you're ready, don't be stressed. You don't have to do it over the weekend. I just wanted you to be able to make contact with one another, come up with a plan. Maybe you guys want to get together and do it next Monday or Tuesday or something, but at least you're sitting together and you get a chance to meet one another. Any questions before we get started today? All right. I'm kind of excited. Today is probably one of my favorite days of the whole semester. And we're going to have a great time, I hope. So here's the plan for today. First thing we're going to do is, I always try to review. If you did an RA quiz before class, I want to review it, just make sure everybody's up to speed on it. And then we're going to play a game today. It's called Name That Company. And it's going to give you a chance to really get to know one another well and maybe do some thinking about what's on the balance sheet. So today we're focusing on the balance sheet. I'm going to introduce a couple of topics that maybe you probably hadn't thought about yet. So we'll talk about historical cost and fair value. And we're going to talk about Coca-Cola. And we're going to look at their balance sheet and talk about something called goodwill. And at the end, we're going to do some practicing with transaction analysis, okay? So my goal is to get through all of this stuff in about a half hour so we can spend the last half hour or so of class just practicing and practicing what you're going to do ultimately on this first group project. All right? So let's get started here. Your RA quiz. If you read the chapter, it was supposed to kind of just review basic things that we've talked about in the previous class. So you learned the accounting equation, right? Assets have to equal liabilities plus equity. In other words, the assets that you have on a company's balance sheet, the things that you have that are of value, had to come from somewhere. Either you borrowed the money to buy them or you had investors invest the money to buy them. So liabilities and equity will always be equal to your assets. So the first problem is very simple. Oh, by the way, let me point out, the numbers change from semester to semester. And I don't always update my slides. So it's the same exact problem. You might have seen slightly different numbers. So don't stress if the numbers look a little different. It's the same problem, okay? So in each case, you simply had to solve for the missing number, right? Assets equal 175 plus X, solve for equity. In this case here, assets equal the sum of liabilities and equity. You're just going to add those two up. And over here, you're saying assets equal X plus 71,000, solve for X, right? So these are the numbers you would come up with in this particular version of it. So fairly straightforward. No heavy-duty math, no calculus. This is a little bit of algebra, right? Next question. Number 2, cash collected on accounts receivable. So accounts receivable, we sell somebody some products. They owe us money, right? So accounts receivable is a good thing. It's an asset. They owe us cash. And so if they pay us, in other words, we collect it, what's going to happen? Cash is going to go up. Do they still owe us anymore? Once they pay us, they don't owe us, so the accounts receivable goes down, right? So what's the effect here? We're going to have an increase in one account, cash, right? Cash went up, and the accounts receivable went down because they don't owe us anymore. So increase in one asset, decrease in the other. Question 3. So we're going to start at the beginning of the period. So snapshot, beginning of the year. We've got assets of 120,000. Where did those assets come from? Well, we borrowed some money. We have liabilities. And we have investors have invested money, right? So we have 60,000 in liabilities, 60,000 in equity. That's at the beginning of the year. Well, what happens during the year? During the year, the company's going to purchase office equipment on account. So what's going to happen to office equipment? It's going to go up. We've got some new equipment. On account means what? We haven't paid for it yet. We owe them. So assets are going to go up. And so what's happening on the other side of the balance sheet? Liabilities are going up, right? So we're going to increase assets by 10. We're going to increase liabilities by 10. So what are the balances at the end of the period? This will go from 120 to 130, and this will go from 60 up to 70, right? Again, the accounting equation always stays in balance. All right, before we get to question 4, let me review with you. So we've already talked about the balance sheet. Assets on one side have to be equal to your liabilities and your equity. And we mentioned last time, we have two kinds of assets, roughly speaking. We have current assets. Those are assets that are going to either be used up or converted into cash within 1 year. Long-term assets are assets that are going to last longer than a year, right? Over on the liability side, any obligation that we have to pay within a year is called a current or short-term liability. And anything that's going to be paid over a longer period of time will be called a long-term liability, right? So given that backdrop here, the question says, which one of the following is included in current assets? So which one would it be? Accounts receivable, right? So taxes payable is a liability, common stock is an equity account, and automobiles, that is an asset, but hopefully they last more than a year, right? So there would be a long-term asset. Before we get to question number 5, what happened? Something weird happened here. Sorry about that. Here's the accounting equation. The expanded accounting equation says we can break down stockholders' equity into common stock and retained earnings. And retained earnings is made up of what? Income for the year, so revenues minus expenses, and of course, dividends. Guys, I'm going to tell you this. I'll use the same slide several times. This is probably one of the most important single snapshot slides you're going to see leading up to exam number 1. Okay, exam number 1, I'm going to give you a lot of multiple choice questions, and they have to test a lot of concepts simultaneously, making sure you understand how things work together. This single slide helps you kind of see the expanded accounting equation, how all these accounts fit together. So I could anticipate seeing several questions on the first midterm where you're given most of these numbers and you've got to go back and solve for one. So if I gave you all these numbers but forgot to tell you what expenses were, it's kind of like a little algebra problem. You've got to solve for expenses, right? Or I might give you all of these numbers and forget to tell you what common stock is, and so you're going to have to solve for common stock. So again, this is a really important sort of foundational type concept to understand. All right, question number 5 says, Prague Company reported the following financial statement data for its most current year. So beginning of the year, snapshot, how do we bounce out at the beginning of the year? We've got common stock of 95,000 and retained earnings of 175,400. What happens during the year? We earn some income, so we have net income. We pay some dividends out to our shareholders, and then we issue some new common stock. So some new folks come along, we print up stock certificates for them, they pay us cash. All right, so issuance of common stock relates to, so our beginning balance of common stock plus the additional shares issued, right? is going to give us our new balance in common stock. And retained earnings will start with the beginning balance plus net income minus dividends will give us our ending balance there. So if you take these two numbers here, common stock, 95 plus 16, that'll give us our new balance in common stock, plus retained earnings. We have our beginning balance, plus net income minus dividends will give us our new balance in retained earnings. So our total stockholders' equity at the end of the period is going to be the total, 309,300. Okay, so not difficult if you had kind of gone through the reading for the day. Any questions before we move on? All right, here's the fun. I want you to take a couple minutes, introduce yourselves, because, again, you're going to get to know each other really well. Because, by the way, I forgot to mention this. Part A of the group projects is due next Thursday. Part B, same project, is due the following Thursday. So you're going to spend a lot of time together over the next 2 weeks. All right, so take a couple minutes to introduce yourselves, then we'll jump into this game. All right, guys, I'll let you exchange contact information. You probably want to exchange cell phone numbers, things like that, so you can text one another after class, okay? So hang with me now. This first activity, if you'll turn your assignment sheet over, here's the handout for the day. So we've got several important exercises we're going to be working on. And the top one, the very first one, is this game. We're going to play this game again next week. It's kind of fun. Don't be stressed about this. I'm just kind of getting you to think about companies that you should be familiar with and what maybe would these kind of companies be like. And we're going to be learning about the different types of accounts that would be on a balance sheet. Okay? So all you got to do, don't stress about this, is just kind of look. I'll give you a list of companies, and I'll basically have a company describe itself. And you ask yourself, who best fits this profile? All right? So first one we're going to talk about is inventory. What is inventory? We talked about it last time. What is inventory? The stuff you have that you sell, right? So we have lots of assets that we want to keep forever, but we have some assets that we're planning to sell to other people. So if we're a merchandising type company or a manufacturing company, the inventory is the stuff we sell, right? Okay, so this company says, I have 43 billion in inventory. This is 21% of my total assets. You should find this at the very top of your page. 21% of my total assets of 204.5 billion. This is an average of 3.7 million in inventory for each of my 11,718 stores worldwide. Am I ExxonMobil, Google, Walmart, or Apple? So I want you to talk in your groups and see, because for some of these companies, this kind of description may not make sense, right? So you're going to have to vote in a few minutes about which company you think it is. So ready? Go. All right, guys, what kind of a company is Google? What does Google do? How do they make money? They're a service company. It's an internet kind of company, right? They provide information. They have a lot of really cool apps and things that we use. How many of you use Google at least once a day? Okay, probably all of us, right? So, but is Google kind of based on a business where they have stores in your town and you go visit Google? No, it's totally on the internet, right? So having 11,718 stores probably doesn't fit Google all that well, right? How about Apple? Do they have Apple stores? Okay, how many of you have an Apple iPhone? Got mine sitting up there. Okay, have you ever gone into an Apple store? So they do have stores, right? Now, are they the kind of company that has tons and tons of inventory in the stores? You see it like on the shelves everywhere. Okay. How about ExxonMobil? What does ExxonMobil do? Yeah, they produce oil, petroleum products. Are there gas stations? Are they owned by ExxonMobil or are they franchised out? Oh, okay. How about Walmart? Do they have a lot of stores? Yes. Do they have a lot of inventory in those stores? Yes. Okay. So who do you think this might be? Walmart. Yeah, how about Walmart? Okay, so that's a pretty easy one. All right, let's move on to the next one. So the next one is talking about receivables. We just mentioned that a second ago. But when you sell something to someone on credit, that means they owe you for that, right? And so it's a kind of a good thing when people owe you money because that means in the future you're going to be collecting cash. So receivables is a good thing to have. It's an asset. Well, this company says, I have $141.4 billion in receivables. This is 69% of my total assets of $205.96 billion. So a huge portion of their asset side of the balance sheet is made up of receivables. So am I Google, SunTrust Banks, Home Depot, or Boeing? Talk about it.
What is Boeing? Boeing is an airplane, yeah. It's not. Google has a lot of intangibles.
All right, before we talk about this one, I want to just take a vote without giving any hints or anything. So you can only vote for one company. How many in this room think that this company is Google? Nobody? Okay. How about SunTrust Banks? Anybody for Home Depot? Hey, just because people raised their hand before doesn't mean you can't raise them now. How about Boeing? Okay. I was just in Seattle last weekend. Boeing is huge, right? Big place. So in order to have receivables, like when they sell airplanes, do you think people pay for cash right up front? Or maybe do they extend credit? Maybe. All right. So most of you voted for SunTrust Banks. Why would you say SunTrust Banks? That's how they make money. What do banks do? They lend money, which means you have to pay them back, right? You have to pay them interest plus the principal back, receivables. So it turns out most of you who raised your hands were right. Okay, but some of these other companies were pretty reasonable. They could have been possible alternatives. All right, the next one, cash. We all like to have cash. How many of you actually carry a lot of paper cash in your wallet anymore? I used to carry a lot of cash. Nowadays, it's easier to do things electronically, so I don't carry as much cash as I used to. But cash is a good thing. Can you imagine a company that has a balance sheet where the asset side is all cash, and then they have liabilities and equity on the other side? What kind of company might look like that? Who? A drug dealer. Yeah, okay. That's probably about right. So it would have to be a really weird company, right? Something weird like a drug dealer just deals in cash, right? All right. So let me talk about another type of asset, a prepaid expense. So for example, how many of you have either an apartment or a dorm that you live in? Okay. And of course your landlords trust you because you're a good, upstanding citizen. And so do you pay your rent at the end of the month or the beginning of the month? Why does your landlord make you pay at the beginning of the month? Okay, so you don't get to be there for free for a month, right? Besides, even if you paid at the end of every month, when we got to May, what would happen in May? You'd all scatter and head home, and you'd probably never pay your May rent because you'd be gone, right, by the end of the month. So yeah, landlords want you to pay in advance. Well, once you pay for your rent in advance, what does that represent to you? It's an asset. You have now the right to park yourself and your stuff in that building, in that room, for the next month. And it's the same way with a business. Sometimes companies will pay for their rent 5 months in advance, 6 months, or a year in advance, which gives them the right to operate their business there for that period of time. It's an asset. So prepaying for something represents an asset. The same is true with insurance. We often pay for our insurance in advance, rent, etc. Okay, so those types of prepaid expenses represent an asset. Okay, so it's a future economic benefit to the company. All right. Here's another type of asset, property, plant, and equipment. So this would include buildings, trucks, machinery, anything that's going to usually last a long period of time. So this particular company says, I have $252.6 billion in property, plant, and equipment. This is 72.5% of my total assets of $348.6 billion. Am I Google, Bank of America, The Gap, or ExxonMobil? Talk about it. All right, guys, I would consider this one to be a little harder. So I'm going to ask you just ask for a show of hands before we talk about it. How many of you think this is Google? Nobody? How many think it's Bank of America? The Gap? Are you serious? Usually I get a lot of hands for this one. How about ExxonMobil? All right. Well, okay. So why did nobody choose The Gap? Why would you say it's ExxonMobil and not The Gap? Let's back it up. Why isn't it Google? Yeah, it's so they're a virtual kind of company. They do have some assets, right? Of course, they have computers and buildings and desks and those kind of things. But they don't have tons and tons of property, plant, and equipment. Certainly not 73% of their balance sheet. Why is it not Bank of America? They have buildings and everything, but a lot of their receivables, as we saw from SunTrust Bank, are going to be, a lot of their assets are going to be receivables. And so what is it about The Gap? Do they have a lot of inventory? Okay. What's different about their business model from ExxonMobil? What do you think?
Most
Zach?
ExxonMobil's value probably is in like the oil land that they find. They claim.
ExxonMobil has refineries and equipment for pumping, those big pumping, what do you call those big things, those oil rig things? So they have lots and lots of heavy equipment to extract the petroleum from the earth, to refine it, and then get it ready for the end users, right? Well, what about The Gap?
They outsource a little bit for like production.
So first of all, Gap doesn't usually make their own clothing. They outsource it. Someone else makes it, so they don't have a lot of machinery and things like that. Their stores are in malls, a lot of them. And do they own the malls? No, they lease that space, right? So literally they have the shelving in the stores and the displays and things like that, but they don't have a lot of fixed assets. And so you guys were right. This one is definitely ExxonMobil. All right, next one, accounts payable. So it says, I have a lot of inventory, 12.7 billion worth. Much of the money I have needed to purchase the inventory has been provided by my suppliers in the form of accounts payable. So in other words, they buy stuff and they say, we'll pay you later, right? So they have a lot of accounts payable. My accounts payable total is 7.2 billion. Am I Google, American Express, Home Depot, or Verizon? Talk about it. All right, guys. Who did you rule out easily? Which companies could you rule out pretty easily? So who'd you say definitely wouldn't have a lot of accounts payable? Okay, and what's the hint on that? Who said Google? Someone said Google. Is it Liz?
Yes.
Okay, so why'd you say Google?
They don't have a lot of inventory.
They don't have a lot of inventory, so they're not going to owe a lot of people for buying the inventory, right? So that was the hint. Okay, so which companies up here are also not likely to have much inventory? So American Express, what kind of company are they? It's a financial institution, a credit card company, so they don't have a lot of inventory, right? And so they're probably not the ones. How about Verizon? Does anybody have a phone that's through Verizon? Do they have inventory? Okay. And so if you narrowed it down to Home Depot and Verizon, who do you think fits this description better? So there's a little bit, I see here's some disagreement on this one, right? Who's likely to have lots and lots of inventory and it's mostly purchased on credit?
Home Depot.
Okay. Turns out this one is Home Depot. But had some of you fooled on that one, right? So Verizon maybe could have been an alternative for that one. All right, question. Robin?
Why wouldn't it be Verizon? Because everybody, nobody shells out $1,000 for an iPhone X. Everybody with a Verizon phone, they owe money on it.
So the question is, most people when you buy a Verizon phone, you're going to be paying on it over time with your plan. So that's true, but remember, you're the customer. So Verizon themselves, think about it, when they buy that inventory, and it's possible, so the difference on this one, I think Home Depot and Verizon are both very likely candidates here. Now you got to look at some other clue. I probably would have gone to the size, the sheer size of Home Depot. Every time they open a store, they've opened a warehouse, right? And who's been in a Home Depot store? Each Home Depot store is 4 acres. They're huge, and they stack that inventory 30 feet high. So if you think about it, every single store is just full of inventory. And so the sheer size, 12.7 billion in inventory, suggested it probably is Home Depot, not Verizon. But this was a tough one. Okay, I admit this would be the harder one to choose. All right, next one, obligation to deliver services. This is an interesting one. This company says one of my most important liabilities relates to services for which people have already paid me, but I have not yet delivered. The current amount of that liability is $5.9 billion. Am I ExxonMobil, DuPont, Home Depot, or United Airlines? Talk about it. All right, guys. So there are some hints on this one. First of all, right at the beginning, it says that this company delivers services. What does What does ExxonMobil do? They're providing petroleum. Is that a service or a product? They provide products. Home Depot, do they provide services or products? They do have some services, but primarily products, right? DuPont, does anybody know what kind of company that is? They're like a chemical company. Okay, so narrowing it down here, what's the only one that provides services? United Airlines. Now, United Airlines, think about this model. How many of you ever show up at the airport and say, I think I'd like to fly to Washington, D.C. Do you have any flights available? What do? You book the flight well in advance, and do they just say, pay me when you have time? No, you have to pay for it immediately to reserve that seat, right? So they collect all kinds of cash, sometimes months in advance before the flight ever takes off. And so up until that time, what does it represent to United Airlines? They have an obligation to provide the service of flying you from point A to point B. And so that represents a liability. It's an obligation that they now have to provide to you because you already gave them cash. Now they're obligated to provide the service, right? All right, let's go to the next one. So the next one talks about accrued liabilities. This was in your reading for last night. So an accrued liability, this is a situation where you've incurred an expense over time, and you owe somebody something, but you haven't yet paid it. Okay, so the example I was talking to someone before class about is, let's say you have some employees that work for you. They work for you for a whole week, Monday through Friday. You know their wage rate, right, per person. You get to Friday, and it's December 31st. You say, see you later, Happy New Year, goodbye now. They all leave. You haven't paid them yet because payday is scheduled for next Friday. So at the end of the year, when you record how much do I owe, then you have to look back and say, oh, I owe my employees for 5 days of work for which I've not yet paid them, but they've worked, right? So I've incurred the expense. So we accrue that, meaning we record that on the balance sheet as an obligation at the end of the year, even though we haven't paid them yet, right? So that's what's called an accrued liability. And examples of accrued liabilities would be wages payable, like we just talked about. At the end of the year, you owe taxes, but you haven't paid them yet, so you have taxes payable. You might have been running machinery and turning the lights on, so you've incurred a utility bill that you haven't paid yet. Or interest payable, for example. You owe interest and haven't yet paid it. All of these are examples of situations where you've incurred the expense, but you've not yet paid it as of the end of the year. All right? Next one. So the next one is called retained earnings. We've talked about this a little bit last time. This company says almost all of my long-term financing has come from profits that I have generated from the beginning of the company until now that have been kept in the business. My retained earnings balance is $414.5 billion. Am I LinkedIn, Zillow, ExxonMobil, or Facebook? Talk about it. All right, guys, let's talk about it. I'm going to just ask for a vote this time. How many of you think this might be LinkedIn? Okay, a few people. All right. How about Zillow? Does anybody know what Zillow is? It's an online real estate company. You can search for real estate, all right? So it's an online service. ExxonMobil. Facebook. All right. It turns out that I got most of you on this one. Okay? So let me explain why. So the actual company is ExxonMobil. Only a few of you chose them. Now, guys, we live in an internet age, and so we think about these internet companies. LinkedIn is a social networking for sort of business people, right? It's a business social networking kind of website. Zillow, as we mentioned, is a website for finding real estate. And Facebook, of course, is another social networking. It's more for just kind of social, not business social networking. And so almost everybody in the room chose Facebook. Let me ask you a question. How long has Facebook been around? Oh, most of your life. All right. To you, that might seem like an awfully long time. But $415 billion is a lot of money, and it takes a long, long, long time to accumulate that much in retained earnings. So I do not doubt that if in 40 or 50 years we were to ask the same question, maybe the answer would be Facebook. But ExxonMobil has been around for well over 100 years, and they've made a lot of money over the years selling petroleum products, and it's just been accumulating and accumulating and accumulating, so they have this huge balance in retained earnings. So someday, maybe you'll be right, but for right now, it's ExxonMobil. All right, so guys, we have two more short exercises. If you look on your page there, I don't know if I even have them on the page. All right, I'm going to do these next two pretty quickly because I want to spend the bulk of our time on transaction analysis at the end. So the first two exercises here, I'll just quickly go through. So if you have a company and they go out and buy some land, I want you to think about how would you want to record this in your financial statements to kind of depict to the outside world what this investment in land is worth, okay? So let's say Lorien Company purchased land for $200,000 5 years ago. And if you were to go out today and talk to some realtors or whatever that are selling land in today's environment, they might tell you that comparable land sales are, so 13,000 square feet, the average price, sales price is $21.55 per square foot. And so you could then estimate that the fair value of this piece of land is $280,150. So my question for you is, Lorien can use only one number to put on their balance sheet to, explain to shareholders what this land represents. What amount should be represented? Should it be the original cost, $200,000, or is it the $280,180 that it might be worth today? Take just a minute and talk about it. All right, guys, by show of hands in your groups, how many of you thought it should be recorded at 200,000? How many thought it should be recorded at 280,000? Okay, so this is an important debate. So remember we talked about the Financial Accounting Standards Board? I just went to a meeting up in Connecticut 2 weeks ago, and we spent the whole time, like 2 days, debating over the definition of an asset and what should be recorded on a company's books. Because you could make arguments for both of them, right? So if you want to talk about historical cost, what's really good about that number, 200,000? Some of you raise your hands. What's good about 200,000? Why would you want that number? Yes?
It's a solid number. You paid for it.
It's a solid number. You wrote the check, right? You know exactly how much it was. It's verifiable, right? You can trace it back and say, that's exactly what I paid for it. So I think the best argument here is that you know exactly what it is. There's no wishy-washy kind of questioning about it, right? Now, a lot of you raised your hands and said you would prefer fair value. Why do you think that's the better number to have on the books? Alex?
You have to take into account depreciation on a lot of things, so I think that you should also take into account appreciation.
Okay, so some assets wear out over time, right? If you use a machine, you keep using it, it wears out eventually. Some assets go up in value. You invest in land, imagine like New York City, San Francisco, LA. I mean, some places it seems like real estate's always going up. And so which one is more relevant to shareholders? Well, probably what it's worth today, right? Now, what's the downside to fair value today? It changes tomorrow. It's not verifiable. And you may say, yeah, it's worth $280,000. But what happens if tomorrow they're out there digging to build a new something out there, and they discover that people have been dumping nuclear waste on this site for decades? Now it was $280,000. Now what's it worth? Well, now it's worth like zero, and you have to pay like a huge amount to get it cleaned up, right? So market values fluctuate for all kinds of reasons, not verifiable, and it may not last, right? So there are reasons that some people are really worried about using fair values on the balance sheet. So right now, the answer today, if we were to go based on today's accounting rules, when we buy long-term assets like land or buildings, we record them at their historical cost. Okay, now there's a push, a lot of people are debating about this, there's a push to go more toward the idea of fair value, but that's not where we are today. Most assets, long-term assets of this nature, are recorded at historical cost. All right, that's just kind of a philosophical debate for you to be thinking about. Sometimes the right answer really depends on your perspective. But so let's change gears and talk just for a second about Coca-Cola. How many of you ever had a Coke this last week? Or some kind of Coke product? Okay. Dasani water, right? Isn't that a Coca-Cola project? So maybe you don't drink soft drinks, but you probably had a Coke product fairly recently. Well, this is Coca-Cola's balance sheet as of 2017. What kind of assets do they have? Current assets like cash, short-term investments. They've got some marketable securities, some accounts receivable, companies that owe them money. Inventory, lots of inventory. Prepaid expenses like prepaid rent, things like that we talked about. So pretty much the things we've been talking about. They've got property, plant, and equipment, lots of it. They've got trademarks. What is it that gives value to Coca-Cola? The name of the brand, right? That's really what gives it a lot of value. And then they got some weird things down here. What is this one right here? Goodwill. Does anybody have any kind of clue what that is? I just want to point something out about goodwill. So first of all, notice it's 9.4 billion right here. Now I'm going to go back, flash back about a decade. So if I go back to 2009, how much was it then? 422, right? So what do we see happening here? Oops, I'm sorry, let me go back this way. Okay, so total assets have doubled, right? And goodwill has doubled. Well, what is goodwill? Any idea at all? So first of all, let me distinguish two kinds of assets. So buildings, equipment, machinery, things that you can touch, these are called tangible assets, right? This particular asset, goodwill, is an example of what's called an intangible asset. You can't touch it, right? So goodwill represents the value. So if I go out and buy a company, am I just going to say, oh, here's your balance sheet. I'll pay you $48.67 million for your company. Are you just going to look on the balance sheet and pay them what it says on the balance sheet? A lot of times there's more value there than is actually showing up on the balance sheet. When you buy a company, you typically have to pay a premium, right? What are you paying for? What was that extra value? Above and beyond what's the fair value of their assets? What's that extra that you're paying for? Is it Keaton? Right.
Brand name.
The brand name. It's the reputation of the company, right? They've built up a customer base, a loyal customer base over years and years of selling and marketing, and people trust them. They like their products. So they've built up all of this reputational capital, and it doesn't show up anywhere in those other accounts, right? It shows up in what's called goodwill. We'll talk more about this later, but goodwill can only show up on a company's balance sheet when they buy another company and pay more than the fair value of that company's net assets. So it's when they're paying extra to buy a reputation of a new company that they've acquired, we record that as goodwill. So why do you think goodwill more than doubled from 2009 until now? They've acquired a bunch of companies, okay? So that's the idea, is that Coca-Cola over this time has actually been involved with a lot of acquisitions. All right? So I just wanted you to kind of become familiar with some of these different types of accounts that you wouldn't normally see. All right, so let's move on now and talk about transaction analysis. Last time I sort of introduced my way of thinking about how the financial statements articulate together. And that's what you're going to be doing with this group project. Now, last time we focused on the balance sheet and we did a little bit of transaction analysis. Now we're going to start adding into that the notion of the income statement. So a company earns income through their operating activities. They're going to have inflows and outflows of assets. And so that's what we call net income, right? So in a company that sells products, they're going to sell those products and then bring in cash, hopefully over time. And some companies sell services. So when you provide a service for somebody, they owe you money. So that's a revenue. So revenues are inflows of assets from your operating activities. And expenses are the outflows. So if you're going to sell inventory, you got to first buy the inventory to then turn around and sell it to somebody else, right? So that's going to be an outflow of resources to buy those inventory items. All right, so we're going to add in. So these are the transactions we did last time. So if you look at your notes from last time, we did 4 simple transactions. They were all related to the balance sheet of that company, right? So we had issued common stock, we purchased property, plant, and equipment, we purchased inventory, and then we paid a vendor. So if you remember last time, this is the simple transaction analysis we did right at the end of class, all right? Now I want to just point out one thing. Cash, accounts receivable, inventory, PP&E, that's all assets. Over here we have accounts payable and wages payable. Those are liabilities. And common stock and retained earnings, those are equity accounts, right? So that's our balance sheet. But you'll notice we hadn't done anything last time with respect to revenues and expenses. So what we're going to do now is pick up the same exact company, and we're going to go on and provide some additional transactions. Some of these transactions are now going to affect the income statement. So we'll show you how we record those. Those income statement items we're going to record, they eventually end up being closed out into retained earnings. So we'll show them over here as revenues and expenses. All right, so in the middle of your page, you've got a simple transaction analysis form. It's exactly what you see right here on this screen. And this is picking up right where we left off last time. Are you with me? All right, so let's start right there. So we're going to now pick up transaction number 5. Did I give you the transactions? Oh, yeah, at the top of the page, upper right-hand corner. Do you see them up there? All right, so let's go through the next several transactions, 5, 6, 7, 8, and 9. All right, transaction number 5. It says, sales of, so remember last time we bought a bunch of inventory? So we've got $55,000 in inventory. Now we better get to work and start selling that stuff so we can make some money, right? So it says, sales of $72,000, of which $30,000 is collected in cash, and the remainder is on credit. All right, so when we make this sale, a couple of things are going to happen. We're going to collect some cash, and then the amount that they haven't paid us yet, what do we call that? Accounts receivable. So, right, so we're going to have some cash and some accounts receivable, and we're going to earn some revenue. So we're going to record some revenue over there, right? So let's first of all deal with that transaction. What was the total sales price? $72,000. So we're going to show that as sales revenue. The cash is going to go up by how much? 30, and accounts receivable is going to go up by how much? 42. All right, so this would represent the sale, right? So sales revenue, I put it in the revenue column over here, 72,000, and I show an increase in accounts receivable of 42,000 and an increase of cash of 30,000. Every transaction has to, every line, every row has to keep the accounting equation in balance, right? Now, at the same time, what just happened? I sold inventory. I'm recording the sale, but there's another part to this transaction. What else? Yeah, our inventory went down, right? The inventory went down. So it says the cost of the inventory sold was $44,500. So my inventory is going to go down. Now, I just had an outflow of resources, right? So that represents an expense. So just as this last one, an inflow of resources is going to be a revenue. An outflow of those assets is going to be an expense, right? So this time we're going to show a decrease in inventory of $44,500, and I have to show an expense over here, cost of goods sold, the cost of what I sold, right? So a decrease in inventory, and I'm going to show an expense over here of $44,500. So now, guys, if I just a note here, you should probably off to the right here somewhere make a little note, right? So what does this $72,000 represent? What kind of revenue is that? Sales revenue. I sold products, right? So I would write sales revenue over here on the right. What does this $44,500 represent? It's the cost of the inventory that I sold. So we call that cost of goods sold. So I'd make that note over on the right. So far, so good? Next transaction. Number 7. I'm now going to collect $37,000. Remember these folks right here? We sold them inventory, and they said, we'll pay you later. So now they're paying us. It's later, all right? So what happens when I collect the cash? Cash is going to go up. Accounts receivable is going to go down. All right, so we're going to show an increase in cash and a decrease in accounts receivable. Now, did the accounting equation stay in balance? Yeah, I increased one asset, decreased another, so I stayed in balance. All right, next transaction, number 8. Employees' salaries for the period total $14,000, of which $13,000 is paid in cash, and the remainder is scheduled to be paid next period. So when our employees work for us, what have we incurred? An expense, right? They work for us, so we're going to have to pay them, right? It's going to be an outflow of resources for us. And what's the total amount that we're going to owe them? Well, okay, sorry. The total expense that we've incurred is $14,000. $13,000 is paid in cash now, so it's going to be a decrease in cash. And the remainder, $1,000, is something we'll pay them later, so it's going to show up where? Wages payable. So let's think about this transaction again here. So Over here, this is going to be wages expense, 14,000. And it's made up of what? Well, 13,000 in cash went down, and an increase in wages payable, 1,000. Does this keep the accounting equation in balance? So guys, the way I want you to think about it is these revenues and expenses over here, think of them as affecting the retained earnings column, right? So in other words, this is going to be a decrease in retained earnings. We've got an increase in wages payable. So on this side, the net on this side is going to be a decrease of 13 net, which equals a decrease on this side of 13. Does it keep it in balance? It does. All right. Transaction number 9. We're now going to record $200 of depreciation on the building. Now this is a concept we'll talk more about later. But when you buy a building, we're going to record it at his historical cost, right? So it's in our property, plant, and equipment. And over time, what's going to happen to that building? It's going to get slowly kind of, decreasing in value. It's going to be slowly sort of used up. And so we record what we call depreciation expense to sort of recognize how much it's gone down, how much has been used up of that asset. Okay? So we're going to show this as, very simply for now, we'll show it as a reduction in property, plant, and equipment, and we'll show it as an expense over here on this side. So negative 200 on PP&E, and we're recording it as an expense over here. Again, you should be labeling these, right? What was this 14,000? Wages expense, I'd write that over here. What does this 200 represent? Depreciation expense, all right? So now, at the end of the day, if we've been careful to make sure that every single row along the way through the transaction analysis keeps in balance, then when we get to the end, we should be able to total things up. So what's our total net income for the period? We had sales revenue of 72,000. We had cost of goods sold, wages expense, and depreciation expense. So our net income for the period is 13,000, right? Now who does that net income belong to? To the owners. So we're going to close that out into retained earnings. Okay, oh, sorry. Here's our income statement. Sales revenue, 72,000. Cost of goods sold, 44,005. So our gross profit is 27,500 minus salaries, wages expense, whatever we called it, depreciation expense equals net income. All right, so that net income is going to get closed out, what we call closing the books. We're going to close that net income out, and it will end up as part of our retained earnings. And so now we can subtotal down here to the bottom. So at the end of the period, our total cash is 58,600. Total accounts receivable, 5,000. Total inventory, 10,500. Property, plant, and equipment remaining is 3,200 balance. We have accounts payable, 23,000. Wages payable, 1,000. Common stock, 40,000. And retained earnings, remember it was beginning balance at the beginning of the period. Remember the equation for retained earnings? Beginning balance, 0, plus net income, 13,003, minus what? Dividends. We didn't pay any dividends to the shareholders. So that would then equal our ending balance of 13,300. All right, so that's the basic idea for transaction analysis. Let's see here. So this was, if you kind of think about during year 1, here's the stuff we recorded last time. So this would be our beginning of the year balance, like a balance sheet snapshot at the beginning of the year. And this would be our balance sheet at the end of the year. This is annoying, sorry. There we go. Now you can see it a little better. All right, any questions on this transaction analysis? Yes, Madison?
What do I record the 200 as?
Depreciation expense. Yes. All right, so this is the balance sheet at the end of the period. So guys, when you're doing your group project next week, when you do this transaction analysis, the bottom row at the end, the totals, that's your balance sheet as of the end of the period. And this stuff over here represents your income statement for the period, right? I showed you the spreadsheet for the group project. This would represent the beginning balances, so last year's balance sheet, and this would represent the end of your balances that you're going to put at the very end of the problem. Question?
So these are technically two different documents?
Yeah, so this was the balance sheet at the beginning of the year. So snapshot, January 1st, and this would be the snapshot, December 31st. right? Okay, so guys, this practice problem, we don't have a lot of time, and I was going to have you kind of work on it with your groups. I tell you what, if you don't mind, I'm just going to walk through the transactions with you, and we'll come back and review it again next time. Does that sound fair enough? All right, so again, guys, this is as close as I can give you to being what you're going to do next week as a group for group project part A. All right, so just hang with me. If you look at the bottom of the page, you've got these exact same transactions. So we've got 13 transactions, and then you've got a transaction analysis sheet down there. And just try to follow along. I'll just kind of move kind of quickly because we've got about 10 minutes left. All right? So transaction number 1. Oh, by the way, we'll assume 0 balances across the top. So our beginning balances would all be 0. So it's a brand new company starting up from scratch. Transaction number 1. On July 1st, owners contributed $240 in cash in exchange for common stock. So for each transaction, I'm going to ask you, what 2 accounts are affected? Do they increase or decrease? All right? So what 2 accounts are being affected here? Cash and common stock. Cash is going up. Common stock is going up. So we're going to record an increase in cash of $240 and an increase of common stock of $240. Pretty simple, right? Transaction number 2. On July 1st, signed a 1-year lease on a warehouse, paying $60 in cash. And we talked about leases before and rent. So we're actually paying some cash today for the right to do what? But these numbers are small. Imagine them in millions or thousands or whatever, right? So we're paying for the right to keep our business here for a year. So by paying that cash, what are we creating? A prepaid asset, right? Prepaid expense is what we call an asset. So in this case, cash is going to go up or down. Cash goes down, and prepaid expenses or prepaid assets are going to do what? Go up. So now we've got a decrease in cash, and we've now got prepaid rent of $60. All right, transaction number 3. On July 1st, acquired warehouse equipment for $100. A cash down payment of $40 was made, and a note payable was signed for the balance. So in this case, we've got 3 accounts being affected. What are they? Cash. Cash is going to go down. What else do we have? So equipment, right? We're going to put it under PP&E. So equipment's going to go, I won't tell you yet. And then what's the other account? We've got notes payable. Okay, so cash is going to go down. PP&E is going to go up. And notes payable is going to go up. All right, so decrease in cash of 40, increase of property, plant, equipment 100, notes payable increase of 60. Again, guys, just look at every single row. Does it keep the equation in balance? Is accounting easy? This is great. All right, next one, number 4. On July 1st, paid $24 cash for a 2-year insurance policy covering fire, casualty, and related risks. So what's this an example of? A prepaid asset, right? So we're going to pay cash now, which means we're going to have insurance protection for the next 2-year period, right? So it's going to affect what 2 accounts? Cash and prepaid assets or prepaid expenses, right? So cash is going to go down, and prepaid insurance is going to go up, right? So we'll record decrease in cash, increase in prepaid assets. Question number 5. Acquired assorted merchandise for $35. Now, what does the word merchandise mean? It's inventory that we're going to sell to people, right? So what 2 accounts are being affected? Cash and inventory. Cash is going down. Inventory is going up. All right, so we'll show decrease in cash and an increase in inventory. But again, it keeps us in balance. Question or transaction number 6. We acquired assorted merchandise. This time it's still inventory. This time we purchased it on account. So what 2 accounts are affected here? Inventory and accounts payable. Exactly. So inventory goes up and accounts payable goes up, each by 190. All right, next transaction, number 7. Total sales were $200, of which 30 were for cash. So now this is the first time we're going to sell some of that inventory off, right? So 2 things are happening. We're going to record sales revenue. That's the sales price of the merchandise. And we have to show that there's 3 accounts affected here because part of it was collected in cash The part that they haven't paid us yet would be considered accounts receivable. So we'll have 3 accounts affected here. So cash goes up by 30. Accounts receivable goes up by 170, and we're going to record sales revenue over here. So guys, on the right-hand side of your page, I would make a note, this 200 represents sales revenue. You have to kind of label those things, so you've got to prepare an income statement later. All right, now there's another part to this transaction. I sold some inventory. I've shown the sales revenue. What have I not shown here? Those people walked out the door carrying inventory, right? So I got to show what? A decrease in inventory, which represents when it's an outflow of assets, right? That inventory walked out the door with this customers. So what do we call that? It's an expense called cost of goods sold. So we have to simultaneously record the cost of goods sold. So the cost of that inventory was 160. So we're going to show a decrease in inventory, and we're going to show an expense over here called cost of goods sold. So again, guys, over on the right, you want to annotate this 160 and say this is cost of goods sold. Sometimes we just abbreviate it, COGS, cost of goods sold. All right, we're getting close here. Number 9, rent expense was recognized for the month of July. Now remember, we paid for was it 2 years or 1 year? I can't remember. 2 years? 2 years of rent? I think it was 1 year of rent. 1 year of rent. Okay, so we paid rent 60. It was supposed to represent a whole year. So how much is it per month? 5, right? So prepaid assets, if 1 month goes by, right? Does that make sense to you guys? $60 for a whole year. That's $5 per month. Again, think of it in millions or thousands or whatever. It's 5 per month. So once 1 month goes by, we've now done what? We've used up 1/12 of that asset, right? And so we're going to show a reduction in prepaid rent, and we're going to record an expense over here. What do we call this expense, guys? What asset was used up? Prepaid rent, so we'll call it rent expense. So off here to the right, I would make an annotation and call that rent expense. All right, quickly now, we need to finish up. Depreciation expense, so our building is going to be used up, and it just tells, we'll assume that it's decreased in value by $2. So we're going to show a decrease in property, plant, and equipment, and an expense over here. Again, anytime an asset is used up, so this is the building being used up, we're going to record it as an expense, and this time we're going to put a label over here and call it depreciation expense. All right, hang with me, guys. 3 more transactions really quickly. It says insurance expense was recognized for the month of July. So the prepaid insurance 24 was for 2 months, $1 per month. So if a month goes by, we've used up $1. So we'll record a decrease in prepaid insurance, and we'll call this over here insurance expense. Last 2, number 12, collected $35 from credit customers. So these folks right here are going to pay us some, right? So we're going to have a decrease in accounts receivable and an increase in cash. So cash goes up, accounts receivable goes down. Last one, it says we dispersed $80 to trade creditors. So we have accounts payable. We owe them $190. We're going to pay $80 of that. So what's happening to cash? Going down, accounts payable going down. Right, so as of the end of the period, guys, real quickly, this is our income statement. Here's the income statement. I'll let you look at that after class. The income gets closed out to where? We close it out to retained earnings. And these will be our ending balances. So this will be our balance sheet as of the end of the year. All right, guys, please practice this on your own. Practice this, and we will pick this up again on Tuesday. Thank you. Have a good weekend.